Hello, hello, hello. Hello, hello, hello. Testing, testing, testing.
Oh,
Ah, somebody's in the room. Rose, can you hear me?
I can hear you now.
Oh,
Yeah, I can hear you. We can hear you. I just turned my mic off because I have the music on for my baby.
Oh, I don't see your colleagues yet. Just giving them a few more minutes to see uh, if they'll roll in. They'll probably roll in a little bit later, but let's just give them a few more minutes. And if they don't roll in, then, like the Bible say, where three are gathered.
Okay, no problem. Mr. Wilkinson, we still waiting on these exam results.
I know, I know. Call me any names you want, roast me. I've been, I really, really had my mind made up to blah, 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 and I'm still marking bits and pieces. I won't bore you with the details, but I'm at your mercy now. I'm almost there. Just that I have to keep starting and stopping for other stuff, unfortunately.
Okay.
But from what I can see, most of the answers were good. There was a couple that went somewhere, and then one or two that were a little ugly. But for the most part, it looks like folks actually did some
So I
study.
might want, I now want to do with a little ugly.
Uh, yeah, one or two persons left off, so, like one or two questions for some reason. I guess they just couldn't remember whatever it was.
I know I ain't not then.
But I always encourage students, even if you don't remember for sure, just make up something, write something you remember, and you never know. Sometimes something crops up and you can still get extra credit. Just next time in your final, don't leave it blank. Just write anything to the best of your knowledge or your ability, and you never know. Sometimes you pick up points even when you don't intend to. Your chances are better. Okay, but
God,
but for the
God,
most
I feeling down, Mr. Wilkinson.
down, why?
I after four when I write on my term paper today, but I didn't save it, so I can't. I lost it at work.
What?
Yeah, at least I was in. That was like when I counted, it was like 352 words. That was just like my introduction, and I was so like feeling good. But like now, like I just feel like discouraged right now, or depressed. Let me put it more
You
depressed.
lost you lost the whole thing?
Yeah,
Are
up
you
to the introduction.
are you sure you lost it?
Yeah, because I did all through. I leave work late and all after five, trying to recover it.
So how did that happen, Gretchen?
And I don't. I thought I was saving it, and I normally would save it as PDF also on the desktop. But today I didn't decide to save my document as PDF also. At least I can open it up in Google Docs if I do it done it that way. I could try again in the morning to see if I could get lucky and recover it some kind of how. But like you thinking and then whatever and you do and I them thoughts don't come back.
Well, not quite the same way.
No.
Um, and just the fact that you have to start all over again is a little unsettling. As a matter of fact, it stinks. But anyway, um, yeah, it's one of those things that stink. It's certainly one of my greatest concerns whenever I'm doing, especially if it's an important document. Nowadays, what I do in recent years is I just make, as soon as I set it up, I save it, and I keep trying to save as I go. Sometimes too often, just so that I don't have to get stuck with that kind of situation because it's horrifying.
I just do that too, but I know what happened to thing.
Yeah. And then again, you have a day like today where it just doesn't happen for some reason, which is unusual because you normally do it. So the only thing that can probably resolve that problem, Gretchen, is a good night's rest when your class is done. Go to bed and snore it off or something, and then get up fresh tomorrow. Check it out, see if you might get lucky, and then if you don't, you just take a deep breath and start again.
Yeah,
Yeah.
yeah, I can't do nothing else today. But I know what I wanted my introduction, but I, how I want to format my analysis or whatever. I still have them fresh in my mind, but all I think in the day and rereading, proofreading, and changing things as I go to make,
Yeah,
solid.
I know it stinks. But the good thing is, if you start redoing it quickly, a lot of that stuff is still in your mind, whether you realize it or not. Once you start writing,
Yeah, in the morning when hopefully I ain't got too much to do to work tomorrow.
yeah, it may not be in exactly the format you had it, but a lot of that stuff is still in your mind. Okay, so definitely. And make sure you save as you go. Every 2 or 3 paragraphs, whatever it is, save. Hit the save button just to be sure.
I was setting to save one, but it wasn't saving. As I know, I opened it up for my email, but it opened up as a Word document, so I was just hitting save. I know I didn't do the save as. I figure, I don't know what I was thinking.
Yeah, I mean, what were you saving it to? Where was it going?
I don't know. Hopefully I could recover it. And I gone and managed documents to try recover it, and they asked them for the file name. What is the file name if something you save? Like, come on.
Yeah, it's crazy. What do you remember if you had a heading?
Yeah, I had a heading.
Try using the heading as the file name, see what happens.
Okay, I can try it. Hopefully it's in the morning. Okay, thanks.
I know it's very discouraging. All right, I see Karen Sands entered the room, so let's get started. The others will join us eventually. All right, I don't see Danielle yet. India is not here yet. I know Gretchen is here with that bloody thing. That even has me distressed, and that's not even mine, because I know how it feels. Okay, Rose is here. And then Karen. Karen? C Sands. Okay, I guess he's trying to make a connection. All right, well, you know what? Let's get started. Folks will have to kick in as we go. Today, we're going to look at the module that talks about verification, evaluation of assets and liabilities by the auditor. This module is not as long as some of the other ones, so depending on how it goes, we probably might be done a little bit earlier, which means that you'll have time to.
Hello?
Hi, who said hello?
Just me. Okay, now you can have me.
Karen?
Yes.
Okay, great, great. I was just wondering if you were getting your mic together.
Mm-hmm.
Okay. So yeah, so this particular module, if you've looked at it at all, is not a long one. It's not a short one, but not as long as the other ones. But it's a very important one, and so I want to take a little time to make sure we talk about some of the really key elements. And again, some of this stuff might actually even apply to some personal things in your life, other conversations in your life. Remember, I told you it's not just for persons in auditing. There are a lot of other expressions that keep coming up if you notice that can be of benefit just to know what they are. And you never really know when you may have to know what they are, at least to be able to function. So again, it's never a waste of time. I think by now we all have an idea, or we should know, hopefully, the difference between an asset and a liability. Does anybody know the difference between an asset and a liability? Period. Not just for auditing, just for in general. Anyone? The difference between an asset and a liability. Have you ever heard those words before? Anybody? No?
Yes, we've heard them. Asset is more of like something that you own,
Yeah, an
and
asset
a
is something you own.
liability is something that you owe.
Yes. Very simple. Couldn't put it better myself. An asset is anything that you own, and a liability is anything that you owe. Okay, so in terms of the company that's being audited by the auditor, what the auditor is interested in doing is coming into the company, your company, and looking at whatever assets the company has, whether it's cash, equipment, land, inventory, whatever the assets are, they're all owned by the company. The auditor wants to inspect them, but not just look over them quickly and run off just to say he looked at them. Some other things are going to be happening with them during the audit process. Right? Even, for example, when you go to the bank to get a loan, one of the things on the loan application that the bank will ask you is, do you have any collateral? Collateral, and of course, Karen is at Bank of the Bahamas. What section of the bank do you work in again, Karen?
I just came with a data. I am in loans now.
See that? All of a sudden, you're on loans now. When you started, I told you, life is funny, funny. So now you're in loans, and you're gonna hear a little something about, yes, what happens in loans. Doggone it. Trust me. I keep telling students, and I'm glad you said it. I keep telling students, no matter how pissed off or tired or whatever it is you might be, when you sign up for stuff, it is never a waste of time. You should always give it your best shot and try to get as much out of it as you can, because you never know where you're going to end up. See, Karen, when we started, when I said introduce yourself, she said, I'm in that stinking boring data thing. She didn't say those words, those are my words. And now suddenly she is in loans. All right, Karen. So,
Okay.
how long have you been in loans?
A month now.
Month. What do they have you doing for starters?
Um, Pop-ups, filing, loan waivers,
Yes, that's
stuff
good.
like that.
Yep, that's good. Getting your hands wet at the bottom of the heap, because
Yes,
eventually
sir.
you move up the heap. Okay.
Yes,
Uh,
sir.
now student loans, when you finish passing my class, you there's a credit and collections course offered at the institute that you should consider looking at now that you're in the
Mhm.
loan department. Okay,
Definitely.
take a look at it and start planning for the near future, not the midterm, the near future, and get some stuff in while you can. And I don't know if your institution pays for you, but if they do, half, quarter, all, whatever it is, take advantage of it while you can. Okay?
Okay, I will.
Good stuff. So, for example, if you are a loan officer, one of the things that loan officers do when you come in for a loan is ask you if you have any assets. And if you say, well, excuse me, I don't know what you mean by assets, and they'll explain to you that an asset is anything you own. You say, oh, I know what that is. Oh, yeah, I have a house, I have two cars, I have some computers, I have an extra piece of land somewhere that I inherited from my grandfather. Whatever the case might be, those are all assets. And so the bank will say, fine, you want to borrow our money, you need to put up something, one of something of your assets as collateral. Okay. And if you agree to do that, then what the bank will do next is to try to determine the value of the asset that you're putting up to see if it's enough to cover the amount you're trying to borrow. Okay. So, and that's in a loan context. This valuation of assets we're talking about in an auditing context is a little different, but the principles are the same, as you'll see. Okay. So the auditor wants to come in, of course, not only make sure that the assets are there, but to make sure that the assets, the dollar amount that is sitting on the balance sheet with the assets are in fact reasonable and or correct. Okay? That management didn't just make up some numbers and make up some assets, because sometimes some firms put assets on their balance sheet that they don't have because they want to make the balance sheet look better than it really is, to impress the auditors, to impress the shareholders, to impress persons on the outside like the bank, who, if they want to borrow money. So sometimes they act fraudulently and put assets on the balance sheet that they don't really have. So when the auditor comes in, that's you guys, you have to go in. If they said, if you say on your balance sheet that you have three pieces of equipment in Andros, then the auditors should fly to Andros with somebody from the company and verify that those three pieces of equipment are actually there. Okay? And that whatever company says they're worth, the auditor will then have to check that to see if that figure or amount is reasonable. Okay? Same thing with liabilities, especially uh, the fact that companies sometimes like to hide what they owe so that creditors and shareholders and other people can't see that the company owes a whole bunch of money, okay, in the millions and gazillions of dollars. And so again, when the auditor comes in, they have to check to see what liabilities there are, make sure that they're actually real liabilities, nobody made them up, nobody's faking them for some reason, and just pretty much do a full check to satisfy themselves, again, that the information is correct. Okay, that's the key. Big time job, but not, well, could be complex in some cases, depending on what type of assets they're looking at, what kind of debts they're investigating, and so on. But generally speaking, in principle, it's the whole idea is to check to make sure that what management says is on the balance sheet actually exist and the numbers are true. Okay? Now, for those of you who actually had a look at this module already, you'll see that Spicer and Pegler made an attempt to define the word verification. And according to them, verification suggests a looking into or an inquiring into the value, the ownership and the title, the existence and possession, as well as any liens against the assets. Pretty interesting definition of verification. In other words, verification really means checking out everything. Okay? Checking to see if the company really owns the asset, that the value that is on the balance sheet is correct, that they have title to the asset, just like you have title to the car that you bought. Do they actually have possession of the asset? Is it really already in the company's possession, or they don't have possession yet, but still showing it? And of course, any charges against those assets. For example, did the company go to get a loan and put up any of those assets as collateral? Because remember, once assets are put up as collateral, the company still owns them, but technically the bank owns them until you paid off the bank. Because if you don't pay the bank is going to seize it officially and sell it in order to pay off the balance. Okay? So that's verification in a nutshell. It's kind of the auditor satisfying himself about the existence and accuracy, etc., of all assets and liabilities on the balance sheet. Inspecting them, checking them, adding them up, looking for evidence. If you say you have land, then they want to see the auditor should ask to see the conveyance. Make sure the conveyance is properly drawn from the seller to the buyer, and all the information that should be there is actually there. The auditor is not completely clear on the conveyance issue, they can consult an attorney. Remember, the auditor can consult other professionals and pretty much have them look at it and verify for the auditor that everything is in order. Remember, auditors are there to check stuff, but they don't know everything. That's why they have the ability to check with other people, other professionals, other persons within and without the organization if they need additional information that they may not be qualified to deal with, which of course makes sense. So in short then, when we talk about verification, we're talking about checking for existence. Existence of what? Existence of assets and liabilities. Make sure they are there. Believe it or not, many company management people at the board level, they do a lot of lying and deceiving and faking. And they actually add stuff to the balance sheet that don't exist and take off stuff to hide them so auditors cannot find them. Okay? Believe it or not. So this thing is very real. And oftentimes when we're talking about assets and liabilities, we're not just talking about a few $1,000s. Oftentimes we're talking about millions of dollars, and in some cases billions. Kind of mind-boggling, but it's true. So verification has to do with the existence of the assets. Make sure they're there. Make sure the company owns them. They have legal ownership. But sometimes companies have stuff in their balance sheet. They don't own it. They just put it there to make it look good. Called cooking the books, prettying up the balance sheet to impress shareholders and lenders and all those kinds of persons. Okay? So it's very important. Making sure that there are no liens against it, like no banks are holding anything as collateral. And if they are, then you have to get the details of why is the bank holding it as collateral? Against what loan? How many loans? What amount? Any other collateral? And so on. Okay? And certainly, number 4 talks about correct valuation. If the balance sheet says that the cost of the asset is 3.5 million, you don't simply take the word of management and say, oh, great, it sounds like a good number. You have to actually check the documents. Where's the invoice? Where did you buy it from? How did you come up with 350, okay, or 3.5 million, and so on? And the auditor, this is why people don't like auditors a lot, because auditors have to be very inquisitive, ask a lot of questions. Anybody in this room ever been part of an audit?
Me, well, internal audit.
Yeah, internal audit. Okay,
Mhm.
that's a start. What has anybody been involved with an external auditor coming in? Like the auditor talking to you about stuff, asking you to get information that they need to see, and so on. Has anybody ever been a part of that kind of external audit? No?
Yeah, and Royal Bank.
Okay, I would hope so. Yep. All right. Now, Royal Bank have internal auditors too. Okay. In the old days, they used to come from Canada to check things out ever so often. Sometimes they tell you they're coming, other times it'd be surprise audits. And then, of course, the external auditors who are different from the bank's internal auditors. And very
Right now,
important.
nobody likes when they come because when they ask some questions, you better know the policies and procedure.
Absolutely.
And they be asking that, like asking you just like normal, like they talking to you all the time. Hmm.
Yeah, they're checking you out, writing you up.
Yeah.
Yep, absolutely. And by the time they finish writing up, if you have too many write-ups, then the branch gets a bad report. Then you have to fix a whole bunch of stuff. Then a lot of people take the blame for things. The manager of the branch is upset. Some managers have to end up being uh, transferred, and depending on how bad the inspection went or the internal audit went. And so, yeah, this whole auditing thing, internal or external, could be quite an experience. Okay, which means that any information you have, language, from involvement, like this, what you're doing now, academically, anything like this, will be most helpful whenever the time comes. Because remember, let's remember Karen. A couple of weeks ago, she was in data processing. Now she's in a whole new world. Okay. All right. So the verification process is quite involved. It involves physically inspecting assets and liabilities, making sure that they're real, they exist, nobody's making them up, okay? As well as any debts or liabilities, again, um, that that the company might have. I cannot stress enough how important it is to do this, because at the end of the day, the auditor is looking to come up with a true and fair view. And it's hard to come up with a true and fair view if you haven't checked information out to some degree and to some reasonable degree. And in some cases, like cash, in some detailed degree. Okay, for sure. So, a couple of key things we can say with regards to the auditor's objective. They're really very simple. They relate to everything we've already said so far. It's not complicated. So, if I were to say, list 3 or 4 of the audit objectives that we discussed, they're not going to be hard to do. Number 1, they exist. Very important. Don't go anywhere until you find if they're there or not. Don't add up any numbers until you check to see if they're there. They may not be there. Remember, some firms make stuff up. Believe it or not, you'll be surprised. Not only should they exist, but they should belong to the company. They shouldn't be, for example, goods on consignment do not belong to the company. Consigned goods are just sent for the company to sell on behalf of another company. And whoever's doing the selling will get a percentage on each sale. But the actual assets are not owned by the company that's selling the goods. They're owned by the consigning company from usually from abroad or some other place. Anybody here ever heard about consignment?
I heard about it once on Love and Hip Hop, but I didn't really understand what it was. This woman went to um, sell a ring that her baby daddy proposed to her with. She wanted to send it back to the jewelry shop. Now they say it was to be $10,000 if she just sell it, and then $15,000 for consignment. But I didn't understand what they were saying. It just was going with the flow.
Yeah. And you're not alone. A lot of people who are not in the business of dealing with consignment don't really know and don't bother to know either. But basically, if you were to check out at any point, the concept of consignment is really just taking possession of assets that you don't really own. You're getting them from another source, and the agreement usually is that you agree to sell whatever it is you're taking on, whether it's cars or jewelry or whatever the case might be. And for every car or piece of jewelry or asset that you're selling for someone else, some other company, you get a commission on that sale. Okay? But whatever is left and not sold actually belongs to the company that gave you the goods put on consignment, meaning you're only holding them to sell, make a commission. The rest of the money goes back to the company. Whatever is unsold, those assets, whether it's a vehicle or jewelry or whatever the case might be, they still belong to the person who consigned them to you. And that's you really don't have any full ownership on a consignment. They belong to someone else. Okay, for sure. All right. It's kind of like if somebody's married, um, and they have like a girlfriend or boyfriend. The girlfriend and boyfriend is in the relationship is it's kind of like consignment. You don't really own them. You just whatever folks do, um, and it's kind of like that. Let's throw that out so you can remember. All right. So make sure the assets exist. Make sure they
Yeah.
belong. Question?
Oh, I thought you called my name.
Oh, that's okay. Make sure they belong to the company if you're an auditor. Remember, we're looking through the auditor's eyes. Make sure uh, that there are no liens or encumbrances against the asset, like nothing is up for collateral, but the company owns them completely. And if there are anything is up for collateral, the details of that assignment as collateral needs to be made known. Some companies get loans and use assets as collateral. When the auditors come in, they try and hide it. Okay, they may not put the loans on the book, so the auditor cannot see the loan. Okay? So they may actually, and sometimes again, these loans are multi-million-dollar loans. These are not just little itsy bitsy 10,000, 10,000, 300,000 loans. These are very, very significant loans that management is playing games with. And they know very well that they should not be doing that stuff. There should be full disclosure. Shouldn't be hiding anything from auditors. If you mess it up, fix it next time. If you made a mistake, then correct it. But we really should not be in the business of hiding stuff. And if an auditor discovers that anybody in the firm, from the top to bottom, is actually hiding information, then it makes the auditor even more suspicious, and they may spend more time auditing you than they normally would if they didn't get caught. They didn't find you doing this kind of thing. Okay? All right. So when we talk about existence pretty much speaks for itself. That all the assets are there, that they're physically present on the balance sheet date, whatever date that might be, and the auditor's job is to make sure that that is so. That there's possession, verification documents for assets to make sure that they're not holding any assets that does not belong to the company, that company actually owns it, whatever company it is, including where you work. Okay. And notice, so far, we've kind of like rehashed some of the same things over and over because these are basically the key things. So we give you an introduction, we give you some more detail, we give you some more detail, but at the end of the day, it still boils down to product existence, possession, and ownership, charges and lanes. Pretty straightforward stuff to remember once you put it in context. With regards to record keeping, it is the auditor's job to make sure that all the assets and liabilities are properly recorded in the books. Oftentimes, they're not recorded because the accounting people forgot to record it, or sometimes it's not recorded because they're instructed not to record it. But the real case of the matter is record keeping must be complete. Doesn't matter who tells you not to do it, you have to defy it. If your boss tells you don't record it, you still have to record it if you're an accountant. If you're an auditor, you still have to check to see if it is recorded properly. Okay, for sure. So if you look on the balance sheet and you see liabilities of $50 million, well, first of all, you have to find out what is that liability for? Who do you owe? And what do you owe them that amount for? And whatever you use that money to purchase, the auditor has to find out, well, where are the assets you purchased? Okay? All because of the record keeping requirement. Okay? And if the auditor checks the general ledger and finds out that the purchase of a piece of property is not recorded in the general ledger but sitting on the balance sheet, then surely something is wrong. Because nothing should be on the balance sheet or the statement of income unless it is properly reported in one form or another. And even in some cases, if you don't have proper bookkeeping stuff in place, certainly you want to be able to have the numbers and the amounts, etc., to verify the transaction by all means. Because you can have great accounting records and still put garbage in, make up numbers, change numbers, make false declarations in terms of what you're posting, put in fake numbers, and so on. Okay? So the recording process is really quite important to the auditor, along with charges and names and ownership and possession existence. That recording of transactions is absolutely crucial. And auditors will be foaming around recording of transactions a lot because they want to see, first of all, the transactions are recorded correctly in the general ledger. Just remember, whatever errors are made in the general ledger, it carries straight through to the financial statements without a doubt. So the recording phase is not an area that we spend a lot of time giving kudos for because there's a lot of background in the back work, but it is also the building blocks of any company's accounting structure and certainly the confidence that auditors need when they come in to see if they need to do full checks or not. Okay? The audit report is another important document. But the truth of the matter is it has to show that all the checks on assets and liabilities have been conducted and properly recorded in the audit papers. For sure. All right. Any questions so far?
Good night, Mr. Wilkinson. Just wanted to show that I'm in attendance.
Okay, who said, Danielle, okay, great. Thank you very much. Let me just make sure I put a little thing here. Okay, so we're looking at, do you have the document we're looking at, the module?
I am currently off the island. So can you tell me which one we're looking at right now?
Yeah, verification. Let me let your colleagues tell you. Somebody tell her. Let's make sure that folks are alive and well. Somebody tell Dana which one we're looking at.
That's verification and valuation of assets and liabilities by the auditor.
Did you hear that, Dana?
Yes, thank you.
Okay, wonderful, wonderful. All right, and we're all the way down to page 3 already. Won't be hard to catch up because we've been carrying on about the really key aspects of verification of assets and liabilities, which I think your colleagues might be able to say by heart now. Uh, the auditor must verify existence, ownership, valuation, make sure that transactions are properly recorded in the accounts of the company, because that is the foundation of all correct information. The audit report must clearly indicate that all checks have been done, and if there are any differences, for example, if the audit is checking inventory, um, sometimes they might find discrepancies. For example, they might look at the inventory report for the end of the year, and it has X amount in the inventory report. Audited requests an inventory count and discover, oh, there are some differences. Once management can explain the differences, then usually there isn't a problem. But if management has difficulty explaining the differences in the inventory valuation or count, or the existence or absence of any assets or liabilities, then things start to get a little strange. The auditor gets a little more suspicious. He doesn't like, he isn't so friendly anymore. He realizes that maybe somebody might be trying to scam his audit, trying to hide something, and so on. Okay? Believe it or not, all these subtleties occur, and I wouldn't say a simple audit. There's probably no such thing, but typically in both internal and external auditors. All right. So going down to the end of page 3, uh, the scope of verifications looks pretty much like all the other stuff that we looked at, but it looks like we threw in a couple of other things. For example, what kind of issues does the scope of verification, scope meaning looking through down the line to see, okay, how far will this audit program extend, and how much does it intend to cover to satisfy the auditor that they can give a true and fair view. Remember, that's really what all the auditors are looking for, enough evidence or information to satisfy himself that they can make a statement that the financial statements are true and fair. They didn't say that make it perfect, and they didn't find any, and there are no errors, and there are no frauds. They're not saying that. What they are saying is they've done all reasonable checks. And after conducting all reasonable checks, oftentimes no errors or frauds show up, at least not immediately. Sometimes they show up significantly after the audit is done. And when that happens, depending on the impact it has on the company, companies often seek to sue auditing firms because they feel that the auditor should have picked up the problem that came up after the auditors left. Okay? It's a hell of a presumption. It's not a presumption that auditors make. But of course, a company can make a claim. And sometimes they're successful against the audit firm. Okay? Believe it or not. So there's existence, there's acquisition. Number 3, the proper persons authorize the transaction. That's another thing. The auditor has oftentimes checked individual transactions to make sure that the right people authorize them. Because sometimes they have some transactions going on, all kinds of signatures are on them, but they're not all authorized signatures. That's what is so fascinating sometimes. And remember, as innocent as people look doing stuff, some people decide always from time to time that they're going to try something. They're going to do something untoward. They're going to run off with some assets. They're going to lie about the quantity of assets, whatever the reason might be. All too often, folks eventually start to get creative, which is one of the primary reasons why we have auditors coming in every year, and we have internal auditors snooping around all the time, getting in your business at work to make sure that they can catch any frauds and errors as soon as possible. Okay? For sure. So the proper authority is very important. It's something we take for granted when a transaction occurs. We say, the transaction has happened. No doubt the right people handle it. Who the organization designated to handle it. But oftentimes that is not true. Okay? And auditors know it's not true. And so they're coming into your company, your firm, to see if you're violating any of these issues. And oftentimes they do. Okay? All right. Ownership, of course. Let me just make a point about the right of ownership. If a company buys 50 cars for $1 million, now until they physically take possession of those vehicles are not necessarily considered assets of that company, which means that they should not be recorded on the balance sheet until they've been cleared. The problem with that is sometimes folks run into trouble in terms of how they should report, how much they should report, what they're trying to hide from auditors, and what they're trying to hide even from other persons like creditors who have loaned the company money. Okay? So the management of these firms are very shrewd, some of them, not all of them. Not all of them. All right. So why do we bother to verify at all these assets and these liabilities? One of the key things actually is to ensure correct valuation. Okay? If the balance sheet said the assets cost $40 million, the auditors will somehow find a way to verify that that actually cost $40 million. If the books say, the balance sheet says that company has liabilities of $27 million, the auditors have to find a way to verify the $27 million loan. And there are lots of ways to do that. Okay? Does anybody know how we can verify the existence of a loan? Make a guess. How can we verify the existence of a loan? Think about your own life.
By looking at payment history?
Say it again.
By looking at payment history?
Yeah, looking at payment history, that's definitely one way. That's actually an important way. Payment history. And then let me tell you why. I had a client once who had a loan once upon a time, a long time ago. And at some point, something went down and some years passed and all this kind of stuff. And the bank eventually came back to the client and said, you owe us X amount of money. Well, first of all, the client's immediate response was, if you say I owe you, then you need to prove it. What do you think they meant by, what does the client mean by prove it?
Maybe showing like paper trail of where they came in and borrowed the money, et cetera, et cetera.
Absolutely. Making sure that there's a paper trail. In other words, when you borrow money from a financial institution, the first thing the financial institution would do is take an application. That's document number one. The second thing they'll do, depending on the type of loan that you want, is they'll have you sign a promissory note saying, I, India, Johnson, that's when she gets married, I, India, whatever she's going to be, do hereby agree to pay the total of $10,000 over 5 years at $350 a month at an interest rate of 14%. Okay? So that promissory note should be signed by the borrower so that creates evidence. So if these kinds of documents cannot be produced by a creditor who says that you owe them money, then they're going to have a problem trying to enforce that loan, because you have to prove the existence of the loan. If you say somebody owes you, you have to be able to prove it. You can't just jump up and say, sorry?
I had someone I know who was talking to me. I don't know why she was so comfortable telling me this, but she told me how she had a $10,000 loan at a bank, and she didn't want to pay it anymore. So she paid someone at the bank to destroy her file, and so once she stopped paying the loan, they tried to send her the card, but they didn't have the file to send her to us.
Yeah.
To pay back.
Absolutely, Rose. Thank you very much for that example. It's a perfect example of what we're talking about in terms of being able to verify when the auditors come in. That's absolutely crucial. That's a serious thing. All right, and it's happened quite a few times. You just don't hear anything about it. And even though the bank, for example, might be able to go into the computer and punch out his payment history without the proper loan documents to say you agreed and you signed the promissory note and proof that you borrowed the money, then it could easily be argued that that printout that the bank created that on their own to try to just because they didn't have the proper documentation to show. Okay? Same thing happens with court cases. Even here in the Bahamas, there have been times when persons are asked to destroy documents for cases coming up. When the case comes up, there are no documents, so the case has to be thrown out because there's nothing to support it. Okay, so yeah, folks do all kinds of crazy stuff, and the fact that that person got somebody to destroy the documents so they don't have to pay the loan back, as incredible as it seems, it is not unique. There have been quite a few people who've done that over the years. I'm sure not only in the Bahamas, many other places as well, which is why lenders try to maintain a certain amount of internal control. See that word? Over the custody of documents. Not any Tom, Dick, and Harry can manage documents for the same reason, because they're trying to make sure that they don't go missing so that the auditors can verify, and that if they need to make a claim against the customer, they can say, we have proof, here's the promissory note that the person borrowed the money. On that same note, there was a situation some time back where a bank reported the customer got the loan, but they didn't ever get back to collect the loan for some reason. And years and years and years and years passed, 8, 9, 10, 11, 12 years passed. And then suddenly the bank comes up with a piece of paper and say, your loan is still outstanding and you have 10 years of interest accrued to pay as well. And the customer's like, really? Okay, where's your proof that I have a loan? They can't produce it, then there's no loan, just like the case that Rose mentioned. It's as simple as that. On the other hand, when your auditors come in, if you can't produce it, dog eat your lunch, because they're going to start getting a little fussy digging around and they're going to write you up. But there's no documentation nor evidence to support this $15 million loan. And it is imperative that the board does something to confirm and verify the existence of this loan, period. Otherwise, you may not get that unqualified or clean audit that you want. Okay, for sure. All right. Again, it is very important, and we go back to that point on page 4, number 6, in terms of why we do these verifications. And one of the key things is to ensure that there's adequate internal control. Remember that? We talked about internal controls before. And internal controls are just things that we put in place so that the company assets are not lost, stolen, or inadvertently destroyed. Mostly stolen. Mostly stolen. Most times things don't get lost. It's possible, but most times they don't. Okay? Stolen is the real culprit. And these internal controls are designed to cut off the ability for persons to steal. Okay? And in this example that we're looking at in point 6, the internal control, even though oftentimes it's designed for a whole ton of things, in this case, we're saying that those internal controls should be with regards to what we call the acquisition or purchasing of assets, making sure that process goes right. How the assets are used, we call it utilization of the assets, and certainly control over the disposal of assets. Now, these 3 internal control issues covering acquisition, utilization, and disposal of assets are absolutely fundamental to the proper existence and running of any company that's worth its salt. Okay? If you are buying assets for $10 or $10 billion, you have to have a control in place so when the asset comes to the place of business, somebody is there to receive it, check the serial number, record the asset details, including the serial number in the accounting records and permanent records somewhere. So whomever comes in and needs to see, you have a permanent record that the assets were properly acquired. If you don't have the right people in place dealing with that process step by step, you're going to run into trouble. But sooner or later, even with controls in place, people find ways to get around controls. Which brings me to my question for the class. Can anybody think, whether it's on the job or otherwise, of an internal control that exists, but we can actually find a way around it? Anyone? What about at work, right? What kind of program or control do you have at work in any area to stop people from stealing, for example? What control do you have in place?
I can't really think of any on the top of my head. For at the credit union, but I mean at my other job, I work for a bar. So one of the things that he does for us servers who deal with money, the bartenders, I mean not the bartenders, but the manager is right there on the bar to watch us, and then he has cameras around, but it's not. I don't think it's as effective to be able to stop people from stealing. Because a lot of times when you go up to the it's so much people go into the cash at once, and when you reach her, she didn't really know what you get. So instead of you give her $50, and instead of you telling her to give you $35 change, you're gonna give you $20 change, and she can't even say what you get or what you didn't get. Like she just have to trust your word for it.
Yeah,
So I think that might be one.
that is definitely one.
I have one.
Yeah.
Uh, well, in my new role,
Mm-hmm.
before we send out, before I send out any pop-ups or loan waivers,
Right.
it have to be approved by my assistant manager and then his manager before I send it.
There you go. That's another excellent example. Both of them, and interestingly enough, in two very different industries. Okay, but both of those areas are areas where if you're not controlling certain things, things will get away. Especially in a bar, for example, uh, cash is flying everywhere. If there's more than one person going to the cash register, that is a weak control. The worst thing in the world you can do is have more than one person working cash, the same cash box. Okay? Sooner or later, stuff is going to go astray. If you have a cash machine, there should only be one cashier. Okay? When that cashier signs off, you do the count, you balance, the new cashier comes on, but you shouldn't have two and three cashiers, for example, going in to the machine without any control in place, because money is going to fly left, right, and center for sure. Okay? Also, a bar have a lot of inventory sitting in it, alcohol. If you don't have control over how much Henneken you have, how many becks you have, or whatever people drink, then stuff are going to disappear and nobody will be the wiser because nobody is seen to be checking. Okay. So yeah, without having people in place to manage those things, you can have control problems. In the case of the in Karen's case, where her controls are simple. If you want a waiver, I can do a waiver for you. But before I do any bloody waiver, it has to go to two people to authorize and approve, and then she can proceed to give the waiver. Okay? That is what we call a control mechanism as well. And so if you're not clear on what controls are and how they work, those are some additional examples to help you understand. Very important. Okay, for sure. All right. While we're on it, Karen, maybe you can tell your colleagues for their own edification so that they know that they learn other interesting things in an audit class. What do you mean by a loan waiver?
Okay, so all it is just giving you a break from paying your loan. That's
And
all
when
it
you
is.
say a break, how does the break work?
Okay, so when you get paid, instead of the system taking out your loan payment,
Right.
it'll be there available for you, but you can't just get it because it's still a loan account. You'd have to come to us for us to take a no debit status off for you to get your money.
Indeed.
So if you
Uh,
get a 2 month waiver and it's June and you get paid at the end of the month, right? Instead of the system taking it, you could get it at the end of the month. And then August you will get it, and then the system will automatically start taking deductions out in September because you only got a 2 month waiver.
Indeed.
And it will only set you back a year.
Does
Right.
it?
Yeah, that's the only thing. It's just the time will just be longer, but you wouldn't get like addition on your principal or anything. It'll just if your loan was up in 2023, it'll be up in 2024 now.
Yeah, 2 months later, if it's a 2 month waiver.
Yeah.
Does
Right.
everybody get that? Because if you have a loan or you ever get a loan in your lifetime, the question is, in the old days, when I was a loan officer, manager, and all that stuff, but when I first started as a loan officer, every Christmas, Scotiabank would give waivers to those customers who want them so that they can have extra money for shopping. Okay. Sometimes during the Easter, so they can have extra money for Easter celebrations. And then in the summer, of course, maybe July and August, because families will have extra money to buy uniforms or go on vacations or both. Okay. So these waivers tend to have very specific purposes. Some people sometimes even just get a waiver. They make up a reason because they say, "Man, I'm broke and I need some money in that month, so I'll just go in and get a waiver and let the loan run for an extra month because this month I need some extra money for whatever reason people decide that they need extra money for." Others, of course, lead it for more legitimate reasons, as I mentioned, maybe to cover medical expenses, home expenses.
I kind of convinced that that's for the hurricane Dorian system.
Yeah, for the hurricane. How long did you guys give? How long was the waiver?
3 months.
3 months. So in other words, you don't pay anything for 3 months.
Right.
Yeah, and then of course your loan will mature 3 months after the normal maturity date, correct?
Yes, sir.
I don't think so, Mr. Wilkinson. It don't equate 3 months, even though you got a waiver for 3 months, it don't equate to 3 months.
What does it equate to?
Sometimes it puts your loan back a full year.
Why?
That's like
I know what you
when you
mean.
put in the amortization of it, like it doesn't equate to 3 months.
Well, again,
Wicked, that's them, they wicked.
no, see, now let me just, yeah, thank you, Gretchen, for that. And again, this is why your internal audit team needs to be keen so that they could look at these things and review them and see if they actually make sense. Because some institutions are doing things that are unethical. Gretchen calls them wicked stuff, and she's right. Just because it's a financial institution, that doesn't mean that they're always honest and doing things right. Okay, for sure. So again, when you're getting that waiver, make sure you get some information on how that waiver works. Because technically, if you get a waiver for 2 or 3 months, your loan should not be set back for a whole year, technically. If that is the case, something else is going on. And it's probably not a waiver in terms of what we understand it to be. Okay? The typical waiver that financial institutions give. So if you run into one of those waivers where 3 months turns into a year, you probably need an accountant or a lawyer, somebody to help you work that out because something may not be right there. Okay? Usually a waiver, just depending on the time, if it's a 1 month waiver, it just extends your loan by 1 month. So you don't pay for June. So when the maturity rolls around, it runs for an extra month, you pay it, your loan is done. Anything other than that, that extends it into months and a year, yeah, that does beg the question. Like, what is going on with that? Okay? It's that is not a typical waiver. And again, a lot of people don't understand how these things work, and so therefore they can be taken to the cleaners. And some lenders know that people don't know. And
Right,
sometimes
so they don't explain it properly. Why
uh,
explain something and on in word different and in paper it's totally different.
yeah, a lot of times they don't explain it properly. Sometimes they don't explain it correctly. Other
Okay?
times they explain it in a way to make sure people don't understand it, and so on. All of which are wrong. Okay? That is unethical and unprofessional. Certainly.
Mr.
Uh,
Wilkinson, it goes two ways because if you make a principal pay, if you make a principal payment, you would
right.
think that it sets your loan back. It would probably put your loan back. I mean, that would mean that. Do you think that if you make a principal payment, one principal payment, that your loan should only be it should be finished in 1 month less? No, right?
Well, it depends. Now, because see, remember now, when we're talking about a loan waiver, what we're talking about doesn't impact the principal at all when you give a loan waiver. What happens is, let's say your loan payment is $300 a month, and you say, I would like a waiver for the month of July. What the bank will do is they'll charge you with a small interest, of course. Never get anything free, for sure, except coffee, and even then, you pay for your coffee anyway somewhere. Okay, so yeah, what they will do is they'll say, okay, fine, we will set it up where you only make an interest payment for the month of July, and that interest payment will be $50 or how whatever it works out to for that financial institution. So when the loan payment rolls around at the end of July, instead of the like somebody said earlier, the bank taking out $300, they will only take out the interest payment for $50, and you get to keep the $250 to do whatever you want. That is typically what we call a loan waiver, okay, or an interest waiver. And because you didn't make a regular payment that month, your loan will mature 1 month after the maturity date. Period. Anything that's not working like that, something is wrong. Now, that's different from the principal. That transaction that I mentioned just now does not affect principal. The principal remains the same. Okay? That interest payment that you pay for the waiver, that is just a cost that the bank charges you for being so nice to give you a waiver. You're just not going to get it free. Okay? So the bank makes money by actually doing waivers, but the idea is that both sides benefit. The bank makes money in interest income. The customer gets to have money that month that they probably really, really need for whatever reason. Okay? In any case, principal is not impacted by that transaction. So principal remains the same until you go back to regular payments again the following month. And then remember, of course, every regular payment, in this case, $300, whenever you make it, a portion goes to principal and a portion will go to interest as usual. Okay? That's how it should work. If some stuff are going on that's not working like that, then we have to find out exactly what that product is. Certainly, it may not be what we know to be a loan waiver traditionally, depending on what the characteristics of that particular product is that the bank is offering. Okay, because sometimes institutions offer products and call it familiar names, but when in principle the product isn't really that particular thing. So, for example, they might call it a loan waiver, but when you investigate how it works, you find that it actually doesn't work like a waiver at all. It's something else. Okay. Hopefully, we don't have too much of that, but it's possible. Okay. But it's important to know exactly what the process means. And I tell persons all the time when you go to a financial institution, insurance company, or anywhere, and they tell you stuff that you don't understand, please ask them to explain it again. For some people, that doesn't help because they don't understand it anyway. And oftentimes, professionals in these organizations do not speak to certain people in a language they can understand. They tell them all kinds of fussy words and expressions And therefore people are more confused than ever because they really don't even understand the vocabulary of it all, period. Okay, so yeah, very important stuff, all tied up. All that came out of number 6. That's what I'm telling you, it's crazy. And even though this is part of the audit process, this stuff is part of our real life. Because what we just had, that discussion, could impact any of us at any time. If we are borrowers, if we borrow in the future, whatever the case might be, if we need a waiver, we need to understand what a waiver is. We need to understand the language. We need to understand how it works, which is why I asked you to explain it in case there might be somebody in the room who may not have been clear, who might have a loan, who might need a waiver, who might have been given a waiver, but it didn't work that way, and who in the future might get a loan and need a waiver, and so on. Okay? So yes. All right. So the internal controls then, again, where we started with all of this, absolutely crucial to make sure that things are not going astray in terms of acquisition. Acquisition only means purchasing. It's just a fancy word for buying something, an asset. Utilization is a fancy word for using an asset for its intended purpose. And of course, disposal of an asset simply means selling it if you don't need it anymore. So those are 3 good terms to know. If you don't remember the big time sophisticated expressions like acquisition, utilization, and disposal, you can use it simple language like buying, using, and selling. See? But again, unless persons break it down to help you understand that acquisition is buying, utilization is using, and disposal is selling, then you'd be like, oh, stuck, because sometimes people are explaining stuff and the explanation is more complicated than the thing they sought to explain, which is another problem. Okay, so there's your auditor checking on the internal controls to see how well the company is protecting its acquisitions, how well it's utilizing its assets, and how well they're disposing of them. Some companies, when their assets are no longer useful, they throw them in a dump. They put it back in the yard somewhere and say, if somebody wants to buy it, they'll sell it, but they don't really have any control over it. So when employees find out there's no control, they go and find a computer that still works and pick it up, carry it home, clean it up, and sell it. Technically, that's not their computer. It's the company's computer. What they should do is go to the company and say, can I buy this? Because we don't use it anymore. We call it junk. And the company will say, okay, you can have it for nothing, or give us a small sum of money and it's yours. Either way, that transaction should be done so that the accounting department can get a document so that the entry can be passed to move that asset off the records to show that it has been sold. If we do not have any controls in place to do that, assets will be leaving the company's compound in the back, even though they're no longer used by the company. They're still owned by the company. Okay, and they do have value, even if it's what we call scrap value. Scrap value is a little bit that we get for whatever it is, but it still has value. Okay? And so disposal of assets need to be properly managed. Now, some assets, when they're being disposed of, are not all junk. For example, companies in the United States, for example, or other countries that have car rentals. You notice when you go to rent a car, typically, for the most part, it's at least in the Western world, when you rent a car, you don't get a rickety car. True or false? True? You guys don't rent cars?
True.
Yeah. You ever wondered why anytime you go to rent a car, it always seems to be fairly new? Like you don't really get like an old rickety looking car. When I say rickety, I mean like a 7 or 10-year-old car. It always seems to be fairly new. And the reason for that is rental companies buy cars new, and usually after 3 to 4 to 5 years, they dispose of them, meaning they sell them to used car lots, etc., or some such thing. So for the rental car company, disposing a car is not junk. They get paid handsomely. when it's time for them to replace their fleet with a new set of cars for rental. Okay? And so this disposal thing, if it's not being properly accounted for, somebody can actually drive off in a 4 or 5 year old car because nobody's keeping a record of it and take possession or sell it. Okay? That's what we mean by internal controls over the disposal and sale of assets that are no longer being used by the company. Okay? Let's not forget in all things, the auditor is looking for what we call arithmetic accuracy, making sure the numbers add up. Wherever you work in your job and you're working with numbers, you have to always make sure the numbers add up. Double check, triple check, whatever you have to do. Make sure the numbers are correct. Because sometimes if you get careless with numbers, it can create a big headache for a lot of people down the road. Okay? Certainly, if an auditor is conducting an audit, internal or external, and they're checking for arithmetic accuracy, and they run into a lot of errors, they're going to be very suspicious about a lot of things now. Because after every 2 or 3 transactions or situations, there's an error. They're like, oh my God. They tally a document, it doesn't add up. They double check the sub document, doesn't add up. Whatever it is, it's not adding up. It's not accurate. And if an auditor of any kind comes across a couple of them or too many, they're going to get a little uncomfortable and start checking more stuff than they need to check normally. And of course, the final reason for verification is the last, but it's not the least. And it's pretty much making sure that they are properly recorded. Absolutely. You get a mortgage on a house and a bank gives you a loan and they don't record the mortgage, then the bank does not really own that property. The collateral is not owned until it's registered by the lender. So recording is very important. If you get married and you record the marriage documents, then you're not married. How about that? Because there's no record of it. That's why we have something called a marriage certificate. Without that, what is there to say that you're married? There's nothing to say. You could bring a witness in front of Judge Judy, see how that works. But Judge Judy is a strange judge. She'll tell you, how the hell you can go and get married? You had many witnesses. Where's the marriage certificate? Say, well, we don't have one. I says, well, looks like you're not married. Go and do it again. Okay? So recording is absolutely crucial. And recording, making sure that it's in the books, making sure that it's on record. Absolutely critical. Okay. All right. So what then are the advantages of verification? By the way, anyone, what is the meaning of verification again? All is verification, we don't remember the meaning. What is the meaning of verification?
Verifying that all assets and liabilities are true and correct. All assets are on the balance sheet as indicated by the company or firm or business.
Absolutely.
And also their liabilities are true, so there can be life, no loan. Trying to get a loan, something like that.
Thank you very much. Checking to make sure that all assets and liabilities are present, correct, and exist. That's it. That's what verification is. Okay, so don't get stumped by the big old verification. Oh my God, I'm just so overwhelmed with that verification. It's nothing big at all. Okay, checking to make sure. We verify things in our day-to-day lives all the time. Say, hold on, let me check that. When you say let me check that, what we're saying is let me verify it. Okay, you don't take people's word for it. Well, we shouldn't. Does anybody here take anybody's word for it? Like, I'll take your word for it. Anybody does that?
Absolutely
Absolutely not. Suppose it's a family member, would you do it?
not them.
Sometimes family members are worse than outsiders. You have to verify them twice as much as you have to verify
We
who you
have
know.
people, and I have an uncle who sell one car to two people.
Of course. And unfortunately, you're stuck with that uncle because biologically he's your uncle, even though he's out there doing illegal stuff. Okay, absolutely. So some of our own family members, we have to be very careful. And there's nothing we can believe that they say. We know some of them are born liars, some of them lie on occasion, some of them lie for Lent. And whatever it is, we need to know who we're dealing with because sometimes our own can be far more difficult and untrustworthy than people we don't know. Believe it or not. It stinks, but it's a fact of life. Okay, for sure. One car to two people. All right. If if he sells one car to two people, who owns the car? Anyone?
Boy, I don't have no idea. See, I don't know. You have to tell me. A lot of times people asleep, they kind of put stuff inside the glove compartment in case they get pulled over or whatever. And who the first person who we sell it to, she brought the car back for him to fix. Something was going on. While he fixed it, he sold it to somebody else.
Sorry,
So
I'm sorry. It's
I
not.
I'm guessing the next person.
But you can tell me you don't need auditors. You better have auditors to check stuff. Ah, imagine if we didn't have auditors to check stuff. Things are going wrong with auditors checking. Imagine if you didn't have them checking. Ah, so yeah, she brought it back to get it fixed. And while he was repairing it, he found another buyer and collected money twice the same
Yeah,
car.
yeah.
So what did he tell the woman when she came back for the car?
See, this is something that has always been going on. So I don't even know what he told her, but eventually this led to a cascade of events with him doing the same thing to more than like 50 different people until he ended up in Foxville prison.
Yeah,
And
absolutely.
he had to sell all of his assets to pay off all of it.
uh, yeah,
His house, his apartment, his type license. He was in jail for one day and then he was crying, saying he can't take it in there. So he sold everything to be able to pay people back and he's still in arrears like 75 grand.
uh, uh, unfortunately, he deserved everything he got. Uh, under normal conditions, like if the house had burnt down, I'd say that is a very sad situation. But in his case, there's nothing to be sad about. Everything he did with his eyes open, very deliberately, and he definitely deserved all of the pain and suffering that he got. It's really quite as simple as that. We have to be careful how we do things, and we have to be aware that we cannot presume that we can get away with these things indefinitely. Some people think that way. Some get away sometimes, but to a great extent, most of us get caught or stuck somewhere along the way. So yeah, that's great. Hopefully, he has learned his lesson that
No, he has not.
crime does not pay. That's the first thing I taught my children, and I hope that they listen and carry it out throughout their lives. What you cannot work for, what is not properly gifted to you, and you have to be careful how many gifts you take because sometimes people are buying your soul when they give you a gift. You have to be careful who you're accepting gifts from because sometimes you think it's just a gift, but really they're buying a part of you, using a gift as the mechanism to do it. But in any event, try to earn what you have. Try to stay away from a quick buck. Try and stay away from stuff that requires any illegal activity. Okay, for obvious reasons. Okay? And he learned the hard way, and hopefully, he and persons like him have learned their lessons for sure. Because, like I tell them, I can't help you anymore. You're men. you do anything illegal, I'll be upset, I'll be sad, but they'll have to lock you up because unless of course you can prove that you're innocent, then I'll be out there batting front and center. But if you're guilty, I'll see you when you come out of prison. I'll still love you. You're my babies forever. But you can't say I didn't tell you. And so if you choose to do otherwise, you must suffer the consequences. Okay, so hopefully, Rose, he has learned his lesson. All right. What about, oh yeah, number 8, of course, is making sure that assets have been properly recorded. Okay. So you see, this whole thing about the audit is not just about techniques, working papers, processes, checking valuations, internal control. It is about those things, but it is also about everything else we discussed tonight, because these are all part and parcel of the things that come out of audits. These are all part and parcel as to why we conduct audits. These are all part and parcel why we do verifications through audits or even on our own. So now, even if it didn't dawn on you before, because of Rose's story, somebody comes to you now and says, you want to buy a car? You may want to buy it, but you're going to be buying it in a little different way. Your first question is going to be, who owns this car? Where are the ownership documents? Where are the insurance documents? Let's go to road traffic and let them verify that this is a legitimate sale. And you'll do everything you need to do, because now Rose has made you suspicious of anyone selling a car, especially if it's not a dealership. And even in some cases, you have to check out the dealership. Because sometimes the dealership might be selling stolen cars. How's that? And you don't know, so you have to check out your dealership even. Who's this person? Is this a former gangster? Isn't this the guy who used to run with my cousin them when they used to do all this crazy? So whatever the case might be, even something that appears to be legitimate. Didn't this guy sell dope? Maybe he's selling these things to launder money. How about that? Welcome to verification. If you thought it was just something auditors did to make you miserable, it's not. Verification and all the steps involved in it is a part of our day-to-day lives. And for the majority of us, if we learn how to make sure that we verify the important things in our lives, it'll save us a whole lot of stress down the road. Okay? For example, ladies, let's say you're dating a guy, but for some reason, you have a suspicion that he might be gay. What do? He hasn't said he's gay, but for some reason, there's something in the back of your mind somewhere that gives you that feeling. Of course, you could be wrong. But somehow you say, now that you've done this course, I need to try and verify this guy's status. How will you do it? Anyone? You are now the auditor of your own personal life. See, like, I don't need this audit class. You do. Now, because you have to verify, just like an audit. See, now you have to audit your boyfriend to find out and verify if this thing that you believe is true or not. What do? We know that external auditors have an audit plan. We talked about audit plans, didn't we? What is going to be your plan to verify? Anyone? A real life example of the audit process outside the firm. What do?
Ma'am, Mr. Williams, can I have too much examples tonight? Why you just hit the nail on the head for everything?
It's my foot. I don't know. It's just a
No,
coincidence.
I had that situation happen to me too.
Wow. Rose, what I'm happy about is that you actually raise it, because a lot of your peers in the class may not believe it, but it's true.
But what I had to do for me, he basically made this comment would say every human being has an inner bisexual.
That's
I
what
was
he said.
That's what he said. So when he said
That,
it, I was like,
yeah,
I was
see,
like, I never had no man say that before.
that is a red flicking flag. Okay. Now, he may just been saying that from a philosophical perspective. That's true. Okay. He might just be saying that for discussion purposes. But the point is, even though it might be a purely innocent statement, it does, depending on who you say it to, cause potential suspicion. Maybe nothing. So you now, he may have just been philosophical. So now you have to investigate further. What do you do next?
So I went to my gay best friend. So he didn't really know him at the time. So I asked my gay best friend to just go up to his room, ask him to help you. Well, let him come to your room, ask him to help you hang some posters or whatever, and just talk to him and see because usually gay men have like a gay radar. They call it a radar.
Yeah,
So yeah, so he came back in like 5 minutes. He's like, girl, that nigga gay, that nigga gay. He came back now there telling me that. So once he told me that, I
so
was
so so what was the verdict? What was the verdict by the guy?
yes, he was. He was bisexual. It was true.
Oh my God. Yes. Now, folks, let me just say this. See that example that she gave? That was a real life example of what auditors do all the time when they come to do audits or they're doing an internal audit. See, it's called verification. Notice she gave him the benefit of a doubt. When he said, ah, we should all be able to be one way or the bloody other, which is bisexual. She didn't say, okay, that's it, I'm out of here. She gave him the benefit of a doubt by verifying further, by putting him in an environment to see if a gay best friend will be able to pick it up, which apparently he did. The point I'm making is verification has to do with drilling down until you get to the truth of the matter as far as possible. Okay? To the truth of the assets, the truth of the liabilities, the truth of the amount, the truth about who owns it, the truth about what the balances are, the truth, the truth, the truth. That's what verification is all about. And if you're an auditor or an individual and you're drilling down and you can't get to the truth, you should be very concerned as an auditor or person. If you start drilling down with your verification process and you cannot count, like the Jamaicans say, compound the truth, that's a big problem. Okay. Wow. Thank you, Rose, for those real life situations. They are so real, they're terrifying, but they are true. And individuals and organizations alike are impacted by these kinds of things. And if you don't do the proper verification, dog eat your lunch. Either way. Okay? If you are supervised in a loan department and you don't check things out to verify what your subordinates are saying and doing from time to time, dog eat your lunch. Something is going to go amiss. You have to verify. You cannot take everybody's word for it all the time. Oh, Susan told me it's okay. I trust her. It's my friend. We're in the same church. We sing in the choir. Her daddy's the bishop. So I trust her. That's not good. I'm not saying she's not trustworthy, but depending on what it is, the verification process should not to be applied, notwithstanding. I'm not saying that anybody is up to no good, but they might be. The only way we can protect our organization ourselves is by verification. Okay? So, big talk about verification, scope, objectives, what it is, existence, lanes, recording, everything, all this good stuff about verification, how important it is to the audit process. So, what then are the advantages? I pulled out a couple. This is not an exhaustive list, but these are kind of like four of the key advantages of verification. I think we kind of figured some of this out on our own already. Number one, verification avoids manipulation, period, in your personal life and in your company. In this case, the manipulation of accounts. If you're verifying and checking, whoever's messing with those accounts in the general ledger, it'd be harder for them to manipulate it. If you're not verifying, it's easier for them to manipulate. Simple. Because they know you're not checking. Okay? For sure. Verifying. I remember back in the old days, for example, when I would go to a particular meeting or whatever the case might be, sometimes my phone would ring. When I pick up the phone, it would be my wife. She said, "Hi, honey," and I'm like, "Hello? Is something wrong?" She says, "No, just calling to say hi." Are you at the meeting already? What is she doing? What was she doing? Anyone, ladies?
Just verifying and checking up on you.
If she was verifying that I actually went to a meeting. Okay? And so I mean, I don't have a problem with that. I just use that as an example to show how verification impacts our lives very much like it impacts the organizational life. Okay? So if you think, oh, this whole stinky verification is just for auditing, it is certainly not, because we should be auditing it all through our lives, depending on what's going on individually as well. Audit our children, even like who are our children, have to verify what they're doing. If they want to go to sleepovers every weekend, you have to verify that. Like, where are they going? Are they really going to Sister Thingam now? Or are they going something else, somewhere else? Especially if they're teenagers. What are they doing? Why do they want to go every week? How many boys are in the house? And so on. Verification. Should I let them go at all? What report will I get if I don't control that situation? What are my internal controls for that? See? And that's not even an organization, that's just our lives. So this stuff is quite relevant, well beyond the audit of the firm. All right. So it avoids manipulation of accounts or manipulation in general. It makes sure that people are not misusing and abusing and stealing assets, of course, because you're checking. It makes sure that everything is properly recorded and valued because you're checking. And because of those three things, you can now say that we have a true and fair view to the greatest possible extent. Is it perfection? Of course not. Nothing is perfection. But if you're verifying and you're checking to a reasonable extent, then you can give the assurance to some extent that it's true and fair. That's the whole idea. If you don't verify, you should not give the assurance. Quite as simple as that. But some people don't verify and still give assurance. They don't check anything and come back and say, we swear everything's okay. In fact, they say, we swear we checked everything too. Did you check everything? Yes. God knows it. And they know very well they didn't check a bloody thing. And giving a big time attestation that they did check. Ronald, did you check everything? Yes, I did. And Ronald knows very well that he did not verify. Wow. So, what are the verification techniques? There are three of them that you need to know. One is physical, one has to do with inspections, observations, and then confirmations. Three simple techniques that you need to know. First of all, what is the inspection? Well, it's simple. It's going to the asset physically and checking it. If it's cash, count it. If it's inventory, count it and check it. If it's company shares, check the number sequence, make sure all the share certificates are in place. Any other documents, look at them, make sure they are what they purport to be. See, a physical inspection. That's what that first technique is all about. Then you have the technique of observation. The auditor may not check 100% of everything, but he can observe. Other persons may be doing the inspection. The auditor can watch them do it and be satisfied that what they've done is reasonable. So you don't have to necessarily do it yourself. You can have other people do it. Oftentimes, when a company is taking stock for an audit, the auditor is not there. Sometimes they're there to check parts of it and make sure that the process is going properly, but they may not be there for the 100% of the inventory count. But they may do some spot checks and then satisfy themselves and say, okay, fine, whatever the result is, we are happy with that based on what we have observed. Okay? And then the third technique is called confirmation, written evidence, documentation, preferably from an independent outside party, which is one of the reasons why when auditors are going in to audit the company, they'll send letters to customers outside the organization. If it's a bank or insurance company or some other entity, they'll send letters outside to customers outside and say, according to the records of this company, your balance with them is $17,000. Kindly verifies if check your records and verify that this is correct. And some people come back and say, that's fine, that's about correct. That's exactly correct. Or hell no. According to my records, I only owe them 7,000. Not no stinking 17,000. And then interestingly enough, you might discover that sometimes the client is right outside. Come to find out, it was a typo. It should have been 7 instead of 17. How about that? Confirmation. In fact, the letters that auditors send out to third parties outside the organization are called confirmation letters for the same reason, because they want to verify the existence of the balances that they see on the company books. And sometimes they send them randomly. They don't tell the company which clients they're sending it to. They get a client list and send it out randomly. Because if they tell the company which clients they're sending it to, they might get in touch with the client and try to do some stuff before the auditor gets to verify. Mix up the process if possible. How about that? Wow. All right. So I think I have chatted enough already, on and on and on, while you guys kick back and have coffee and martinis. Let's see. Who did not read the last time? Anybody? Let's see what your peers say. Who did not read the last time? Let's see who we're going to throw under the bus tonight. Anyone? Who are we throwing under the bus?
I would read what
Who said that?
would be making so much noise. This Rose.
Okay, Rose has volunteered to
He's
read.
making much noise, man.
Sorry?
I think maybe you're making too much noise.
Who's making too much noise?
My baby in the background. That's why I don't want to speak.
Well, so far, you are the bravest soldier in the room. You are prepared to read, even with a little one who refuses to keep still, whose job it is to move, and who does not care what any of our problems are. All right. Well, let's give it a shot, Rose. Verification of assets.
Valuation of assets.
Page 5.
This is valuation.
Uh,
Verification. Oh, I see.
yeah.
Okay. The term verification signifies the physical examination of certain classes of assets and confirmation regarding certain transactions. Sometimes verification is confused with vouching, but they differ from each other on the nature and depth of the examination involved. Vouching proves the arithmetical accuracy and the genuineness of the transaction, whereas verification inquires into the value, ownership, existence, and possession of assets, and also confirms whether they are free from any mortgage or charge. The presence of any entry regarding the acquisition of assets does not prove that the particular asset exists at the balance sheet date. Rather, it purports to prove that the asset ought to exist. However, verification through physical examination and confirmation proves whether a particular asset exists without having any charge on the date of the balance sheet. Verification of assets involves the following steps: inquiry into the value placed on the assets, examination of the ownership and title deeds of assets, Physical inspection of the tangible assets, and confirmation regarding the charge on assets, ensuring that the assets are disclosed, classified, and presented in accordance with the recognized accounting policies and legal requirements. The scope of verification is wide, and consequently, verification is an important part of the auditor's duty. An auditor should endeavor to satisfy himself as to whether a particular asset is shown in the balance sheet at the proper value, whether the concern holds the title to the asset, and the asset is in the sole possession of the concern and free from any charge. If the auditor fails to perform his duty, he will be held liable. In the case of London Oil Storage Co. Limited versus Fair Hasluck and Co., Chief Justice Alverstone remarks, it is the duty of the auditor to verify the existence of the assets stated in the balance sheet, and he will be liable for any damage suffered by the client if he fails in his duty.
Wow. Yes. Keep going.
Um, In addition to its legal importance, the verification also plays an important role in guarding against improper valuation of assets, like stock in trade, which may inflate or deflate the profit position of the concern. Improper valuation of assets may also conceal the actual position of the business as reflected in the balance sheet. However, it is not impossible for the auditor to physically verify each and every asset because time may not permit him to do so, or he may not have sufficient technical knowledge of the assets concerned. It was decided in the case of Kingston Cotton Mill that it is not a part of an auditor's duty to take stock. No one contends that it is. He must rely on other people for the details of the stock in trade. In the McKesson and Robbins case in 1939, we find that the auditor should physically verify some of the assets. If possible, the title documents like negotiable instruments, shares, debentures, and securities are to be thoroughly examined on the last day of the accounting period. He should satisfy himself that the transactions, if any, on the balance sheet date and the date of the audit are bona fide and are supported with proper evidence. The auditor is supposed to verify stock in trade with reference to the purchase book, the stock records, and the gatekeeper's book.
Okay, thank you very much, Rose. You did a great job under the circumstances, actually. Thank you very much for that. That's fantastic. So now you see a little bit more, again, just a little bit more detail on how the auditor has to jump in wholesale to make sure that he does all of these checks. As you can see, sometimes these matters end up in court, believe it or not. For example, sometimes when auditing firms are actually completed with an audit and say that the company is showing a true and fair view and the company goes under for some economic reason, a lot of times companies blame the audit, the company for not detecting somehow the real underlying reasons for the failure of the company, and as or even the failure of the company to do better than it actually did. And sometimes they actually sue auditing firms, take them to court, hoping to recover damages because they're blaming the auditors for their ill will, sometimes for their poor management. Okay? But the idea is some companies around the world still think that once auditors come in and leave, that they ought to have detected all the errors and all the frauds. It is humanly impossible to do so. All auditors can do is come in with their plan, verify all the key issues that need to be verified to the greatest possible extent. Now, if it is found that an audit firm has come in and they've done just the bare minimum because they want to get out, collect the money, and move on to another job, and don't do a sufficient job, if that is discovered, certainly the courts will frown upon that for obvious reasons. Okay? But outside of that kind of situation, and again, not all audit firms are ethical either, which is why our final module is going to be on professional ethics. Okay? Because the person is a professional, not everybody who's a professional actually behaves professionally. A lot of them behave very unethically and some of them criminally. Okay? Criminal negligence, criminal behavior, outright criminality, even though they're supposed to be protecting as professionals the interests of the clients. So you can see right away how deep and engrossing this thing can become if an auditor, in or out, decides not to do the job properly. Everybody suffers at the end of the day. Okay? All the relevant documentation, not only the equipment and the land and that kind of stuff, but all other documents like titles and certificates and securities documents, investment documents, all of these things need to be checked. Preferably, we're told at the end of the accounting period, because that is the period in which the audit is actually going to be ending. And so you want to see where these things are as at the end of the financial year. Okay. I think it is pretty clear at this point that there is no room for shortcuts. No matter what type of auditor you are, there isn't even any room for shortcuts if you're responsible for doing the work that the auditors will be checking. And you guys have the good fortune of getting some insight on what auditors are looking for in their behavior. So when you go to work from day to day now, that should help you in the sense that whatever you touch, you have to ask yourself, what if the auditor inquires about this? Are they going to find it suitable? And so this kind of information should actually encourage persons who do this stuff to not only be aware of what the audit requirements are, but to also help you in your day-to-day. And you will discover, no doubt, that you might very well be behaving in that fashion going forward. It's just something, some of it sticks with you, whether you want it to stick with you or not. Okay? Good stuff sticks as well. Notice the comment we made about stock and trade inventory. Again, the auditor is not required to count every piece of inventory. It could be thousands of them. It's not humanly possible, nor does it make any sense. Okay, but they can go and certainly see what the count process is. Watch some counting being done, and then they can satisfy themselves that they have done a reasonable verification of the inventory of a company. There's a little note about the importance of making sure inventory is correctly counted. And the reason for that is if inventory is either over or understated because you didn't do it properly, the income statement and the balance sheet are affected. Okay? That's the point. So it's very important, especially companies whose prime asset are inventories, to make sure that when the stock taking is done, if the financial statements are going to be true and correct, that stock taking process is not something you do but helter skelter. Because if you do not do it properly, it can have a grave effect on the financial reporting. It can affect the auditors because if they give a clean bill of health, presuming that the stock was done properly and you discover that it was not, and there's some major scandal that comes out of it, the auditor might find themselves on the block.
Excuse me, Mr. Wilkinson.
Yes.
Okay, like, so I work over the weekend because we did special assignment mid-inventory count.
Yes.
So that's what you're speaking of?
Absolutely.
But then there's a threshold.
Tell us more. What is the threshold?
I mean, like, okay. For example, like if all the items are not accounted for, and then we had to do recounts.
Yeah.
I even got a list sometime from between last week, from Thursday on to the weekend.
First of all, this is
And the hot warehouse.
yeah, this is a very interesting audit thing. For the purposes of your colleagues who are working in AC and know nothing about audits. First of all, where was the audit conducted?
Me?
I mean, where was the count conducted?
It was conducted on site where
Indeed.
the items are stored.
Exactly.
Supposed to be stored, and they supposed to be in the area where they say it's supposed to be. All that is taken into account.
Now, is everything where they're supposed to be?
Basically.
Okay, then you guys are on the right track. Why is it that the question of recount came up?
Because some items might have been overlooked, or if it was too much missing and the figure will carry it off, like if it's too much money. For example, if 200 items missing and those 200 items valued at, for example, $200,000,
Right?
you can't cut that as a loss.
No, you can't. You have to go back and find out what happened.
So, right, so if you have maybe a threshold of, let's say, $10,000, and if maybe two items out of that 200,000 missing, that's $2,000 within the 10,000 threshold. Now, the key is that when you do the overall inventory, no inventory item adds up to be over that threshold of what the company is willing to, I guess, write off, or you understand?
Of course. So what is the reason for that?
You tell me, please.
It's in the reasons vary. That's why I asked. Every company has its reason as to why they establish a threshold in the first place and why they don't have any tolerance for any thresholds to begin with.
I guess, like in our previous notices, what is the company willing to lose?
Yeah, the management will decide how much are we prepared to just write off if it doesn't pan out. And if that threshold, we don't want that threshold to be too high because we're not prepared to write off a whole bunch of money. Okay, period. Unless of course we have no choice, but we're not gonna do it laying down. We're gonna go back and check the system again. We'll recount again if necessary to see if we
And
made.
that's tedious,
It is.
especially if you got like almost 5 pallets of bolts to count,
$5 of what?
bolts and stuff like that. For example, let's use that as an example.
Oh yeah, it's a nightmare. Or if you have thousands of canned goods and other stuff in the warehouse, it's a nightmare. But you have to come up with a system to come up with a reasonable count, to come up with a reasonable estimate, to come up with a reasonable threshold. And that will vary for every single type of business. Okay, for sure. How long did your inventory count take?
Yes, from Thursday to the weekend.
Yes. All right. Some
I don't
people,
think I like auditing.
well, the problem is, were you involved with it as one of the accounting people or just the auditor watching the count?
Okay. Well, I had the people who actually work in the warehouse. They did the counting and we stood by and we verified as they counted.
Correct. Which of course, even though you're not physically doing the count, you have to be there.
Right. And then we had to make sure that it is indeed. And then, like some of the numbers that were off, like probably might have been like oversight because of how it was set up. I get in the same area, very close, but it's just an oversight. So it didn't turn out too bad. I don't think it will turn out bad if you come up to under half of what your threshold is. What do you think?
No, that's fine. And again, it depends on what dollar value it works out to be, etc. Okay,
Right.
if it's a dollar value that can be tolerated rather than spending a whole bunch of money to redo it again, because time is costly as well. So you have to measure the potential loss against the cost of doing it again. And if the potential loss is lower, then you let it go. You don't do it again. Okay. Again, this is something that management perfects over time. This is something that the audit department would help the management to perfect over time to make it as efficient as possible. Okay. Now the question is, and so yeah, you already acting in your capacity as an internal auditor. That's part of the job. Unfortunately, in your case, you with an organization that has stuff that need to be counted and checked. Okay. Who decides when the inventory is counted? Gretchen?
Well, I guess it's just standard. I guess the management because that is standard.
That is
It,
standard.
yeah. So it
Yeah,
ain't like no surprise. It is not a surprise spot on check like that for
correct.
that particular audit.
Now the person who's the only auditor at the moment, correct?
No, no, sir.
Okay, so you have other people in your audit department.
Yes, yes, sir.
Great,
It's
great.
a Johnny come lately.
Okay, so you have an audit manager and all that stuff.
Yeah, and they have a whole team.
Good. So your audit manager will determine when the audits are done. How many times a year do you do the audit?
That particular one, like twice.
Yeah,
That was the mid-year.
yeah, that was a mid-year. Okay, which is typically how it works. All right. Hopefully one of these days you guys will do a surprise audit, not a full count, just to let folks know that you can come outside of the mid-year and end of year as well. Okay. Maybe you can throw that in the suggestion box and see what happens, or recommend it to your boss, etc. That might be something to consider. It never hurts to do an flash audit from time to time. And it doesn't have to be complete. Just do a quick one just to let people in the warehouse or wherever the stuff is know. Don't relax. Because see, once they know you're coming every twice a year, they can be ready. You understand?
Yeah, but these days I do other spot surprise or checks because I used to have to do it on other
Okay.
stuff
Okay, then you do have spot checks.
very often.
Very good. Obviously. And the reason why I know that you have it often is because whatever you're checking, if you don't check, people will swipe it and you'll never know. For sure. All right. So you're right in the world of the internal auditor. Now you have all kinds of information to refer to when you're doing your work going forward. You can compare your notes to what's actually going on. At some point, when you get comfortable with your job, you can go back to your notes and other information and start making recommendations and suggestions. See, that is the beauty of this thing. That's why you sit out these sessions while everybody's already snoring after dinner and all that stuff to get information, because eventually it's going to help you individually and help you to do your job better, one way or the other. All right. All I can say, money well spent, even though you may not realize it initially or right away. All right. Thank you so much, Rose, for that piece, and certainly Gretchen for bringing the world of verification and audit to life, so that maybe some of your colleagues who may not be physically involved in it, now the fact that you've talked about it, they're like, they can get a real life feel uh, just because you took it off the paper and put it out in front of everybody. Okay? Fantastic. All right, let's see. The lady from Sunshine Insurance. Who's that again?
Are you meaning you mean me, Mr. Wilkinson?
Are you from Sun? She's like, what the hell? Doesn't he know my name? I'm not. I'm Danielle. I sure as hell know it was you. I was just being a little facetious to see if you were still with us. It's been a long day. And Sunshine Insurance has a lot of things going on. It's a lot of work, right?
I'm on vacation. I've been on vacation for a week now.
Oh, so no wonder you sound so fresh, uh, fresh and unconcerned about Sunshine Insurance. The hell with them. I don't hear anything until I go back to work. All right, so I'm not even calling that name anymore. Okay, Danielle, since you're on holiday, you're rested, looking all fresh and feeling good, and don't have to go to work tomorrow and all that like the rest of us. Why don't you pick up, help us to finish off the module beginning with the valuation of assets. I was wondering how come
Valuation.
you sound so bloody chippy. That's the reason. While the rest of us are like, oh my God. Okay. Valuation of assets.
Valuation of assets, meaning valuation of assets means determining the fair value of the assets shown in the balance sheet based on generally accepted accounting principles. The valuation of assets is especially important because overstatement or understatement of the value of assets in the balance sheet is not only distorts the true and fair view of the financial position, but also results in distorted profitability. The valuation of assets is the primary duty of the management of the company. The auditor is required to verify whether the value ascertained is a fair one or not. For this, we may rely on technical certificate used issued by the experts in the field. Valuation of assets means not only checking the value of the assets owned by an organization in the balance sheet date, but also a critical examination of the value of these assets by conducting a comparative analysis of different assets. The auditor must ensure that the valuation principle for assets is consistently adopted and is based on established principles of accountancy. These assets are classified as follows to determine their value. Fixed assets, current assets or floating assets, wasted assets, intangible assets, fictitious assets.
Now, I think if you guys know anything from my first test, that you know that this kind of stuff is like ripe for test questions. So I'm gonna give you a hint for your final. For stuff like this, at least be able to list these different types of assets. They're not hard, and be able to say very simply what they are. You don't have to say it the way your text says it. Just very simply what they are, and we'll see in a moment. Okay, keep going there now.
One, fixed assets. Fixed assets are usually valued at going concern value, which means cost less depreciation. Cost here means the purchase price of the assets plus all incidental manufacturing, buying and installation expenses incurred to put the assets into use. Depreciation is the provision made for the reduction in the value of the assets based on their usage, natural wear and tear, and obsolescence. The depreciation provided should be fair. Otherwise, the valuation of fixed assets may not be fair.
Now, let me say this before she goes on. For those of you who, has anybody in this class ever bought a vehicle new?
No.
No, that's okay. But whether it's new or used, a vehicle is a fixed asset that depreciates in value. What does that mean? Does anybody know what depreciates mean?
It means that the cost of the vehicle becomes less as you drive it off the lot, basically, in that
Yeah,
case.
yeah, as you drive it off the lot and as you use it over time. So every
Time.
year, if you pay $10,000 for it in year one, in year two, it's not going to be valued at 10,000. It's going to depreciate from wear and tear, using it, driving up and down, dropping kids to school, speeding from the other one side of town to the other, going out to fish fry, whatever it is, it causes it to depreciate over time. So year after year, it loses value. All right, and that value that it loses is called depreciation. So let's say you pay $10,000 for it, and in 4 years it depreciates by $6,000. That means when we subtract the $6,000 from the 10,000, the actual book value of the asset is now no longer 10,000, but only 4,000. Okay, that's how depreciation works. If you decide to sell it, technically, of course, somebody in the market can pay you much more than it's worth, or somebody in the market might only want to pay you something less than it's worth. But at least the 4,000 will give you an idea of what figure you should consider depending on the condition of your vehicle. Okay, and that's typically how fixed assets, vehicles, equipment, etc., are actually depreciated as we use it. Okay, the wear and tear is called depreciation, and it reduces the cost over time. Okay, for sure. All right, what about our bodies? Do our bodies depreciate?
I think just about everything depreciates.
Yeah, just about everything, bodies included. For those of you who are still young and all that, don't worry, you're depreciating every day.
Well,
And
except land, Mr. Wilkinson.
except land, yes. Land does not depreciate. Land tends to.
Why not? And the land I'm singing.
Well, that's not real, that's fake land. We're talking about real land. Swamp land is not real land. It's just in terms of for economic purposes. And that's why those persons who end up buying swampland and it starts sinking, they have run into bad luck. They didn't do the due diligence. But remember, what did we say? What's the V word for auditors?
Verification.
They're absolutely. See? And if that person who bought the swamp land knew anything about this class, the first thing they would do is what? Let me check to see if this land is what?
Not
Solid. Yeah,
solid.
absolutely. Or if I don't know how to do it, I will hire somebody like the auditor who is qualified, like a surveyor or some such person, to check it on my behalf and pay them a fee to confirm that it's in order. That's what you do. A lot of people don't do that and they end up literally in the hole on sinking sand. That kind of land depreciates. That's not the land we're talking about, and that's not the land we're interested in. Any other type of land tends to go up in value. Okay. Every other type of asset, though, tends to depreciate. Okay, for sure. All right. So that's
Hiya.
the question. Okay, keep going. You know.
2. Current assets or floating assets. These are usually converted into cash at the earliest opportunity in the process of business activities. Examples: stocks, bills, receivables, and sundry debtors. Based on the convert
Conservatism.
of principal, current assets are usually valued at original value, cost price, or market price. Realizable value,
Mhm.
whichever is lower, because they are intended to be converted into cash at the earliest possible time. The value we realize is important. This method is adopted to strengthen the financial position of a concern by indirectly providing for expected loss by way of a fall in the market value of the assets. This principle is the
Conservatism.
conservatism convention of accounting, which means we do not expect profits, but provide for anticipated losses.
Now, let me just say that that's a whole bunch of accounting mumbo jumbo. And if you're not really part of the accounting world, that mumbo jumbo is kind of mumbo jumbo. For you guys, what's important is that the other asset is called a current asset or floating asset. And basically, these are assets that are easily converted to cash. Okay. These assets are usually recorded at cost or market value. So now notice what I've done. I've taken a mumbo jumbo and put it in language that will make it easy for you to remember. And that's the idea. So when you're looking at this particular asset, all you need to know is that it's a current asset. Okay, it's easily converted to cash. It's based either on cost or market value. Cost is really what you paid for it by invoice. Market value is you go into a store and say, how much is this? How much does this cost? And they say, the market value for this is X amount of money. Now, some people have wondered, like, what's the difference between cost and market? And here's an example. When you buy an asset, let's say a washing machine for $3,000, that's the cost. That's what you paid for it. However, if you take that same washing machine and take it to the market, take it to the market in our language now, it'd be Facebook, the newspaper, in front of your yard, a yard sale, whatever. You take it to market, even though you paid $3,000 for it, you could actually end up getting more or less than you paid in the market, depending on who's in the market looking for a washing machine. Does everybody understand? Does that make sense?
Sorry,
Yeah,
could you
we
go?
understand.
Okay.
Yeah. The difference between cost price and market price is the cost price is whatever you paid for it up front. The market price is whatever somebody offers you for it. How's that? Has anybody in this class ever tried to sell something and somebody offered you less than you thought it's worth?
Yes.
Yeah, that's called the market price. Now, if you think it's worth more than they offer you, then you can decline the sale. Don't sell it to them. Wait until you think you can find somebody who'll pay what? More, right?
Right.
Because that's how the market works. Okay? And the way the market works is different from when you go somewhere and just buy something. Okay? When you buy something, you just buy it at whatever the cost is and you leave. No issue. When you take it to market, you have to know that you're gonna have different buyers, people offering different amounts. And you stay in the market until you get an amount that is satisfactory to you. Sometimes you'll get an amount that's satisfactory, sometimes you'll get more than you thought you'd get, and sometimes you have to give it up for less, depending on your situation and how badly you need the money. That's what we mean by market price versus cost. Okay, for sure. All right, that's what that in a nutshell, what the whole mumbo jumbo is about. And those market prices and cost prices are under what we call current assets. All right, keep going.
Wasting assets. Wasting assets. Hello?
Hi.
Yes. Wasting assets are those assets which lose their value gradually based on their use. Example, a mine and a quarry. To value these assets, we should determine the usefulness of the assets in terms of units of production and based on their actual values. And based on their actual use, the value is to be reduced on a appropriated basis. If in a particular period, this type of asset is not used, then the value may not diminish. Thus, these assets are to be reduced on the basis of consumption. When it is difficult to adapt this method, then the cost-less depreciation principle may have to be applied.
In other words, if you have diamonds or coal or whatever it is in the ground, these are wasting assets. All right, they are depreciated based on how much of the stuff we take out of the ground. So all we're saying here is for these kinds of assets, we simply refer to them as wasting assets because they're based on how much of it is used as we dig it out of the ground. Okay. If you have a diamond mine that is discovered tomorrow, that diamond mine will be worth more tomorrow than it'll be worth 5 years from now. Because over 5 years, what will you be doing? Digging the diamonds out, correct?
All right, so you could overmine it, or you could just have fencing.
Correct. So if you discover the diamond mine tomorrow and it's estimated that the diamond mine is worth 10 billion, over 5 or 10 years, you might take out 5 billion worth of diamonds. So now the diamond mine is no longer worth 10 billion. It's worth what? 5 billion because you've taken 5 billion out and sold it. That's what wasting assets are all about. So where do you get that? Same thing with coal and oil. These are all wasting assets and they lose value as we use it up, as we take it out the ground. Okay? That's why those countries who have diamonds in the ground, they have to make sure that they don't abuse what they have because they might think that they have an unlimited amount and there might be an unlimited amount. Or at some point it might what? Run out. So you keep partying until you run out and you don't have any left. Okay, wasting assets. That's why we call them that, because they lose value as you use it up. Okay, for sure. Just like a vehicle uses value as you drive it up and down. Just like a machine that makes clothing and shoes and whatever it is loses value over time because it's running all day, every day, practically making stuff. Okay, it's being used up. And like most assets, wasting assets depreciate based on how much of it we take out of the ground. Okay. All right, keep going.
Intangible assets. Usually, intangible assets like goodwill, patent rights, and intellectual property are valued on a cost basis. But if the same are acquired by a non-cash transaction, then the fair market value is to be taken as the value of the intangible asset. The auditor should also review the period that is fully written off and ensure they are shown as assets because they do not have a realizable value. They are to be valued at actual cost less the amount written off as depreciation as at the balance sheet date.
Okay, keep going.
Fictitious assets. Certain lump sum expenses which provide benefit for more than 1 year when incurred are written off over a period of time until it is fully written off. It is shown as an asset in the balance sheet. Example, preliminary expenses and discounts on issue of shares. These are all fictitious assets because they do not have any realizable value. They are to be valued at actual cost less amounts written off as at the balance sheet date.
So again, like wasting assets, fictitious assets have their own personality. These preliminary expenses might be legal fees and other professional fees for setting up a type of business operation. And instead of writing them all in one lump sum to expenses, accountants are allowed to depreciate it over 5, 7, 10 years, depending on what agreement is made. So when these preliminary expenses occur in these lump sum amounts, we refer to them as fictitious because they're not realizable. What does realizable mean? You cannot sell them on the market. They have no resale value. They're just expenses that are incurred that you write off over a period of time as opposed to one lump sum figure. Okay. So for you guys, you're not expected to remember all the accounting mumbo jumbo. I just want you to be able to say what the different types of assets are, fixed, current, wasting, etc., and to make one statement by definition as to what they are. Okay? I don't want you to get bogged down in the accounting side of it at this point. I just want you to know what it is and to know that the auditor, depending on what kind of firm is auditing, may be required to be involved in all these different types of audits. Again, some auditors have audited all their lives and they're never really involved in auditing wasting assets, for example. Okay, believe it or not. Some auditors have been auditing all their lives, have never audited inventory because they have audited financial institutions that have no inventory all their lives professionally. See? So everything is relative. All right. So you could be a CPA and you could be an auditor, but it doesn't mean that you've been involved in every type of activity possible. Some auditors have not been involved in half of these things in their entire career. They get stuck in a particular area and they stay there. Okay, for sure. All right. So I just need you to know what these assets are and to make a statement about to be able to list it and make a statement, one sentence about what they are. Okay. All right. Keep going.
Valuation method. The following are various principles of the valuation of assets. Cost price, going concern. Value. Under this method, the actual cost of assets are reduced by the depreciation provided. Usually, this method is used to value fixed assets. Market value. This refers to the market value of the asset. For example, the price at which the asset is being transacted in the market. This is used to value current assets only when this is lower than the cost of the asset. Usually, market value is adopted to value items that are perishable in nature.
Anybody knows what a perishable item is?
Like food.
Yeah, like food doesn't last very long. You have to eat it or you have to throw it away, one or the other. It doesn't hang around long like equipment and land and vehicles and all that kind of stuff. You have to deal with it quickly or it's gone. Okay, keep going.
Scrap value. Assets which are useless for the enterprise may be sold as scrap in the market. The value for which such assets can be disposed of as scrap is referred to as scrap value of assets. Replacement value. This represents the value at which the existing assets can be replaced. That means the price to be paid to acquire such assets in the market on the date of the balance sheet. Realizable value. The value that can be obtained if the asset is sold in the market. That is anticipated selling price. Usually, expenses such as commission and brokerage fees are deducted from it.
Mhm.
Auditor's position regarding valuation of assets.
In case you're wondering about this realizable value and these brokerage fees, this particular area tends to refer to the sale of securities and like stocks and bonds, etc., where we anticipate that we'll get XYZ based on market prices. And once the transaction is done, the brokerage fees and commissions are deducted. And that's how brokers make tons and tons of money in the securities market, by the way. Okay, it's good information there. All right, keep going.
The auditor's position regarding valuation of assets. It has already been pointed out that the auditor is not supposed to have technical knowledge regarding the valuation of assets. Therefore, he has to depend upon the valuation made by the directors, experts, and surveyors. But does it relieve him from liability if certain assets are overvalued or undervalued by the directors, experts, or surveyors? The answer is no, because the auditor cannot provide a guarantee for the absolute correctness when he must depend upon others. And where assets are valued according to the estimated depreciation, he can still be held liable. He must ensure that management seeks to show the fairest possible estimates regarding the valuation of assets. Under these circumstances, the auditor should see the assets are valued according to certain accepted principles of accounting. He should check the estimation to determine if it is reasonable. The auditor should thoroughly examine the available papers and documents to arrive at the correct value of assets. Where there is suspicion regarding the valuation of assets, he should investigate further.
Mhm.
Distinction between verification and valuation. Meaning, verification establishes existence, ownership, and acquisition of assets, whereas valuation certifies correctness of the value of assets and liabilities. Time. Verification is done at the end of the year, whereas valuation is done during the year. Personnel. Verification is done by the auditor, whereas valuation is done by management. Evidence. Title deeds and receipts of payments constitute documentary evidence for verification process, whereas certification by the management is documentary evidence for valuation.
Thank you very much, Danielle. Be sure that that last piece about the distinction between verification and valuation, that is a very popular exam question. So make sure you know that, but not just because of the exam thing. It's just that it's nice to know that if you're an auditor of any kind, internal or external, and even as an employee working within the firm, this kind of information really helps you to understand your environment, understand what's going on with auditors when they come and ask you questions, when they're conducting checks on your work, and all this kind of stuff. You don't feel so alienated because you understand some of the language and the processes and why it is absolutely necessary. As well as the fact that as you work from day to day, you ask yourself, am I following through with what is required in the event and when an audit is going to be conducted? And so it kind of helps to keep you alert subconsciously as well, or in some cases, depending on who we are, consciously, which is not a bad idea. Okay. A very important point to remember is that the auditors have to rely on others, but not exclusively. That the auditor cannot be an expert in every area, has to take somebody's word, but in taking somebody's word, he has to exercise good judgment. He has to try and find people whom he believes will give him fair and appropriate information, because at the end of the day, even though he, the auditor, may not have actually come up with the valuations, at some point, if something goes wrong, the audit firm could very easily be the one that is charged or indicted for any failures. So it's a slippery slope sometimes for auditors, especially external auditors. Okay, some things that they do are pretty clear cut, and other things are very subjective and based on judgment. And those are the things that can sometimes land an audit firm in court in some cases, if especially if the company that they've audited subsequent to the audit ends up failing completely or experiencing substantial losses or even some reputational damage. Okay? Big time important job this audit work is, whether you're external or internal, it's never to be taken lightly. Very important for the firm, very important for the firm's reputation, very important for maintaining the long run substance of the company for employees who work there and expect that the firm will continue to do well. Okay, there's no shortage of importance attached to the responsibilities of the auditor and even the persons who work in the firm who will be subject to the audits. Okay, for sure. All right. Man, you guys have been more than great considering, again, the long days that you've had. For those of you who came in afterwards, I've already gotten my licking for not having your grades yet. You have my word that you will have your grades this week. If you don't get your grades this week, that means I'm dead. You're free to call the police and or the morgue, whatever you think is appropriate in the circumstances, but I will get them to you, I promise. The last week or so has been a total nightmare, but things are looking up. So kind of like Gretchen's crazy stuff. Nobody's talking to Danielle. She's on holiday. That's disgusting. I don't know how that happened. How much time do you have left, Danielle?
I'll be back on. I'll be back on Tuesday.
Tuesday? And
Yeah.
I hope every day beginning tomorrow is a miserable day for you.
It won't be, trust me.
And
It won't be.
I know that's what stinks. You're gonna make sure it's not. While the rest of us are there suffering, ducking COVID, and all that crazy stuff. Truth be told, though, enjoy your holiday. I'm sure you deserve it, and don't let anybody cause you to feel guilty, including me. They try to do it. Tell them they know where to go. Leave you alone so that you can enjoy your time away from work. All right.
Thank you.
You guys take care. I'll see you next Thursday, but you will get your grades before the week is over, or I will definitely be on the chopping block, and I don't want to be there. All right. So take care and be safe.
And